Deep Dive TSMC TSM. Full valuation case and Monte Carlo simulation by Value and Momentum Portfolio.
Institutional-grade research on TSM with catalysts to watch and actionable insights for investing. Company overview.
Taiwan Semiconductor Manufacturing Company, TSMC, is a leading semiconductor foundry headquartered in Taiwan. Established in 1987, TSMC is offering a wide array of integrated circuits and semiconductor devices. The company provides various wafer fabrication processes, including complementary metal oxide semiconductor, CMOS, logic, mixed signal, radio frequency, embedded memory, and bipolar CMOS mixed signal, among others. TSMC's products find applications in high-performance computing, smartphones, the Internet of Things, IoT, automotive, and digital consumer electronics sectors. TSMC's business model is strengthened by its substantial manufacturing capabilities and its commitment to providing customer and engineering support services.
Moat analysis.
TSMC possesses one of the most defensible moats in the global technology sector, anchored by a level of technological leadership that is currently near unassailable. As of 2025, over 3/4 of the company's wafer revenue is derived from advanced nodes at 7 nanometers and below, a feat no other pure-play foundry can match. With their 2-nanometer process entering high-volume manufacturing in late 2025 and the next-generation A16 node on track for 2026, TSMC remains at least 2 to 3 technology generations ahead of its closest competitors. The barrier to entry is further reinforced by staggering capital requirements, as the cost of a single leading-edge node now exceeds $50 billion. While Intel is often cited as a theoretical threat, the immense complexity of modern chip design creates a multi-year lead time for any competitor to ramp up production, a challenge TSMC views with confidence rather than concern. This complexity also leads to extremely high switching costs for customers like Apple, NVIDIA, and AMD. These companies lock their product roadmaps into TSMC's ecosystem years in advance, as shifting to a different fabricator mid-design is practically impossible due to the deep integration of specialized tools and intellectual property libraries. TSMC's dominance is also driven by powerful scale and network effects. Because they process the highest volume of leading-edge chips, they accumulate defect density data faster than anyone else, allowing them to optimize yields with unmatched efficiency. This structural advantage is evident in their ability to achieve yield parity in new locations like Arizona, a scale of execution that competitors have struggled to replicate. Furthermore, the company enjoys significant pricing power, with average wafer prices growing by 20% year over year. Rather than seeking short-term gains, TSMC prices strategically to ensure long-term sustainable returns, maintaining a gross margin floor of 56% through various market cycles. Ultimately, their massive capital intensity acts as a final deterrent, with planned investments reaching toward $180 billion over the next 3 years, a figure that exceeds the total annual revenue of most other semiconductor companies and ensures that no one can casually compete at this level. While TSMC's market position is formidable, there are several factors that could potentially erode this moat over time. The most significant is geographic concentration risk, with over 70% of production centered in Taiwan. Any regional conflict would not just challenge TSMC's business model, but would effectively halt the global technology supply chain, making this a geopolitical binary rather than a traditional competitive risk. Furthermore, the company is on a massive capital expenditure treadmill, with 2026 spending projected at over $50 billion and set to rise. Any deceleration in AI demand could create a capital overhang that materially compresses the return on invested capital. This risk is compounded by the expansion into overseas fabrication sites in the United States, Japan, and Germany, which structurally dilutes gross margins by 2 to 4% during their initial ramp-up phases. Additionally, the transition to the new 2-nanometer node is expected to cause a cyclical margin dip in the latter half of 2026. Despite these headwinds, several pillars continue to reinforce the company's structural dominance. TSMC has demonstrated a consistent ability to turn new technology into profit, with the 3-nanometer node expected to cross above the corporate margin average during 2026. The company has also aggressively raised its long-term growth outlook, now guiding for a 25% revenue compound annual growth rate through 2029. This growth is supercharged by the AI sector, where accelerator revenue is projected to grow by over 50% annually for the next several years. For investors, this fundamental strength is being returned directly through a rapidly growing dividend, which is committed to reaching at least 23 new Taiwan dollars per share in 2026. These financial milestones suggest that while the costs of maintaining leadership are rising, the rewards and the resulting market dependency remain stronger than ever.
Price action and technical context.
From a market perspective, TSMC is currently trading at $341, marking a pullback of approximately 12.5% from its February 2026 all-time high of around $390. This retracement appears relatively orderly on the weekly charts, following a massive structural bull run where the stock surged 190% from its 52-week low of approximately $134. That low point, hit in April 2025 during a period of tariff-related market anxiety, served as a springboard for the current uptrend. Since doubling off the mid-2025 lows of roughly $145, the stock has maintained a strong upward trajectory fueled by the accelerating build-out of global AI infrastructure. While the recent dip from the February peak represents a period of price consolidation, the long-term trend remains firmly positive, reflecting sustained investor confidence in the company's indispensable role in the technology supply chain.
Business performance.
The company has demonstrated exceptional financial performance by consistently exceeding both earnings per share and revenue estimates every single quarter. While the explosive year-over-year growth rate is beginning to moderate from its peak of plus 67%, the momentum remains remarkably strong. There have been no earnings misses to date. Furthermore, profitability has surged over the last 2 years, with earnings per share more than doubling from $1.44 in Q4 2023 to $3.14 in Q4 2025. TSMC generates exceptional value for its shareholders, as evidenced by its strong financial metrics. For 2025, the estimated return on invested capital sits between 28% and 32%. While the return on equity was slightly higher at 35.4%, the substantial cash reserve of $98 billion on the balance sheet naturally dilutes that figure. When adjusting for total invested capital, including both equity and net debt, the return on invested capital remains firmly in that high 28% to 32% range. When we compare this performance to the estimated weighted average cost of capital, which is approximately 10.5% to 11.5% based on the sector's risk profile and minimal debt, the results are impressive. This creates a value creation spread of roughly plus 19%. A spread of this magnitude indicates that the company is performing at an elite level and consistently delivering significant value over its cost of capital.
Analyst coverage.
Recent analyst activity shows a strong bullish sentiment for the stock, with 3 out of the 4 most recent ratings issued as a buy. On January 15th, Needham confirmed a buy rating with a price target of $410. The following day, TD Cowen maintained a hold at $370, while Barclays confirmed their buy rating with a high target of $450. More recently, on February 13th, D.A. Davidson initiated coverage with a buy rating and a matching $450 price target. With the current stock price at $341, there is significant implied upside to all professional targets, ranging from the conservative $370 estimate to the high end of $450.
Unusual options activity.
The current options flow presents a mixed but notable picture of market sentiment. Today's largest single flow was a $13.3 million sweep into May 2026 $340 puts, which was tagged as bullish because it was bought at the bid, suggesting a large player is either hedging or selling into strength. We are seeing additional significant bullish flows in the January 2027 $380 puts and the June 2026 $330 puts, both of which were filled at the bid. There is also bullish protection appearing in the January 2027 puts across the $250 to $300 strike range. Despite these moves, bearish flows remain present, characterized by multiple near-term sweeps in both calls and puts, filled at the ask. Looking at the longer time frame from September 2026 and beyond, the overall tone leans slightly bearish to cautious. Large put buying on elevated strikes between $380 and $400 suggests that major holders are actively hedging their positions against potential downside.
Valuation summary.
The bottom line is that TSMC is currently trading at or marginally below its probability-weighted intrinsic value. At a current price of $341, the stock is not considered screaming cheap, as the base case sits within the $365 to $396 range. Conversely, the stock is not overvalued unless one anticipates a material deceleration in AI capital expenditures or a significant escalation in geopolitical risk. The investment asymmetry remains modestly positive, with approximately 53% of Monte Carlo paths implying upside from current levels. The stock would become unambiguously cheap if it dropped below the $275 to $280 range, which would represent a discount of more than 25% on a discounted cash flow basis and a forward PE of less than 20 times. Key catalysts for a re-rating include a compression of the weighted average cost of capital and a free cash flow inflection as the capital expenditure cycle peaks around 2027.
Monte Carlo simulation results.
To move beyond a single point estimate, we have performed a Monte Carlo simulation consisting of 10,000 iterations. This process involves varying all key inputs, such as revenue growth, margins, and the discount rate, simultaneously within their probable ranges to observe the full distribution of potential values. At the current price of $341, TSMC sits at approximately the 47th percentile of all simulated valuation outcomes. This indicates that the stock is trading very close to its fair value on a probability-weighted basis, with a slight tilt toward the upside. This positive bias is driven by the right-skewed nature of the distribution, which reflects the asymmetrical benefits of long-term compounding. Based on our model, there is a 53% probability that the stock is currently undervalued, as more than half of the 10,000 simulated paths produced an intrinsic value higher than $341. This suggests that while the market has efficiently priced in the base case, the potential for exceptional growth slightly outweighs the risks of a significant downturn.
Break-even analysis.
To determine whether the stock is currently mispriced, we must evaluate what specific financial outcomes the market has already baked into the current $341 share price. At this valuation, the market is essentially assigning a 25 times forward price to earnings multiple based on 2026 estimates, which aligns perfectly with management's own growth guidance. This valuation suggests there is no embedded growth premium in the current price, meaning investors are not paying extra for potential upside beyond the stated targets. Because the stock is trading in line with these baseline expectations, it is clear that the market is not pricing in the bull case at all. Consequently, any performance that exceeds management's guidance would likely trigger a significant upward re-rating. DCF break-even analysis. To determine the minimum growth rate required to justify the current share price of $341, we can work backward using a discounted cash flow model with a fixed weighted average cost of capital of 11%. This calculation reveals that the market is currently pricing in a minimum free cash flow compound annual growth rate of approximately 23% for the first phase of our model. When compared to management's official guidance of 25% growth, the current valuation offers a buffer of only about 2 percentage points. This indicates that the market has a high degree of confidence in management's ability to execute, leaving very little room for a significant growth miss. Any performance below this 23% threshold would suggest that the stock is overvalued at its current price, while maintaining the guided 25% rate provides a modest margin for error. Operating margins. Break-even analysis. When we analyze the break-even points for TSMC's margins, it becomes clear that the current buffer is quite thin. Management has already provided guidance for several significant headwinds in 2026, including a 2% to 4% gross margin dilution stemming from the expansion of overseas fabrication facilities. Additionally, the ramp-up of the new N2 process technology is expected to contribute another 2% to 3% in margin pressure. Essentially, the company has pre-disclosed approximately 400 to 500 basis points of gross margin headwinds for the upcoming year. Because these challenges are already factored into the outlook, the margin for error is narrow. Any additional negative impacts, such as new trade tariffs, unfavorable foreign exchange fluctuations, or unexpected yield issues with N2 production, could lead to material misses in operating margins that the market has not yet accounted for. Free cash flows. Break-even analysis. The central insight of this valuation is that buying TSMC at $341 today requires a long-term commitment. You are essentially paying for the present and waiting roughly 2 to 3 years for the company's free cash flow to catch up to its market price. This is a classic look-through growth investment, where the stock only begins to offer a truly compelling free cash flow yield in the 2027 to 2028 timeframe. The primary risk to this thesis lies in the timing of the artificial intelligence investment cycle. For the current valuation to remain attractive, the massive capital expenditure currently being deployed by tech giants must translate into sustained demand over the next several years. If the AI spending cycle peaks or turns downward before TSMC's cash flow fully matures, the fundamental justification for its current price would be significantly undermined. The single most powerful catalyst for a valuation re-rating would be a compression of the weighted average cost of capital driven by geographic diversification. As TSMC's production capacity outside of Taiwan reaches the 20% to 30% range, it directly reduces the binary risk premium currently embedded in the discount rate. This strategic shift to a more global footprint addresses geopolitical concerns and on its own could add between $80 and $100 per share to the company's intrinsic value.
What could change the thesis?
To wrap up our analysis, we must address the specific risks and variables that could disrupt TSMC's trajectory. These factors range from cyclical market shifts to complex geopolitical and technical challenges. AI capital expenditure reversal. The most significant impact would come from a sharp deceleration in AI spending by major hyperscalers like Microsoft, Google, and Amazon. If disappointing returns on AI investment or new regulations cause a pullback, TSMC's high-performance computing revenue, which accounts for nearly 60% of its business, would contract sharply. In a scenario where revenue growth falls to 8 to 10%, the stock could drop to $220, representing a 35% downside. Investors should monitor hyperscaler CapEx guidance in late April 2026 for early warning signs. Trade and tariff escalation. Trade policy remains a high probability risk. While a historic trade agreement was signed in February 2026 to reduce reciprocal tariffs to 15%, it remains under legal challenge following a recent Supreme Court ruling on executive power. If tariffs are increased or the trade pact collapses, costs for TSMC's U.S. customers would rise, potentially leading to demand destruction. A 10% revenue hit from these pressures could pull the stock down to $312, while direct tariffs on TSMC products could see the price fall closer to $260. Geopolitical escalation in Taiwan. Geopolitical tension remains a catastrophic but lower probability binary risk. Any escalation toward a blockade or conflict would cause a spike in the risk premium, likely dropping the stock into the $180 to $210 range. A full-scale conflict would be devastating, as 77% of TSMC's capacity remains in Taiwan. The company is aggressively diversifying with its Arizona and Japan facilities to reach a 20% to 30% survival line of overseas capacity to hedge against this risk. The CapEx treadmill. TSMC faces the risk of capital expenditures rising faster than revenue. With a $52 billion to $56 billion budget for 2026 and potentially higher spends through 2029, Any delays in the N2 process ramp or construction overruns at overseas fabs could prevent free cash flow from recovering as projected. If free cash flow remains stagnant near $50 billion through 2028, the look-through investment thesis fails, and the stock could re-rate toward $250 to maintain a competitive yield. AI efficiency and competitive shifts. Technical shifts also play a role. Breakthroughs in model efficiency, similar to the DeepSeek shock of early 2025, could reduce the total number of chips required per unit of compute, potentially slowing revenue growth. Furthermore, while Intel's 18A process is now entering mass production, TSMC's N2 node maintains a yield advantage of 70% to 80%. However, if Intel achieves yield parity, or if political pressure forces major customers to diversify their foundry partners, TSMC could face a long-term threat to its market share. Currency fluctuations. Finally, foreign exchange remains an ongoing variable. TSMC earns most of its revenue in US dollars, but maintains its cost base in New Taiwan dollars. Management's current guidance assumes an exchange rate of 31.6 New Taiwan dollars to the dollar. A 5% appreciation of the Taiwan dollar would compress gross margins by approximately 150 basis points, creating an additional hurdle for profitability targets.
What are the upside catalysts?
While the current valuation is grounded in realistic assumptions, several powerful catalysts could drive a significant upward re-rating of the stock. If artificial intelligence demand exceeds even the recently raised management guidance, the impact would be substantial. Management already increased its 5-year compound annual growth rate for AI accelerators to the mid to high 50% range. If sovereign AI projects and a surge in on-device AI for consumer electronics push the overall revenue growth rate to 30% rather than 25%, the implied share price could climb as high as $700. Investors should look for quarterly revenue exceeding $40 billion in 2026 as a key signal of this acceleration. Another major catalyst is the compression of the weighted average cost of capital through geographic diversification. As the Arizona fabs scale toward 30% of TSMC's most advanced capacity by the end of the decade, the binary geopolitical risk premium currently attached to Taiwan will begin to dissolve. Since every 1% reduction in the discount rate adds roughly $84 per share to the company's intrinsic value, a shift from an 11% to a 10% cost of capital would push the implied price toward $425. Operational excellence also provides a pathway to higher valuations. The N2 process, which entered high-volume manufacturing in late 2025, is expected to be a larger and faster-growing node than its predecessor. If N2 gross margins cross the corporate average earlier than mid-2026, every percentage point beat adds approximately $1.2 billion in incremental profit, supporting a higher stock price. Gross margins consistently staying above 65% in early 2026 would be a strong indicator of this trend.
The regulatory environment offers further potential upside. Reports indicate the Trump administration is considering formalizing tariff exemptions for major U.S. tech firms linked to TSMC's domestic investments. Codifying these carve-outs would remove significant revenue uncertainty and reinforce TSMC's status as a critical strategic asset, potentially adding $30 per share by eliminating the current uncertainty premium. Finally, the stock could benefit from both dividend growth and a broader sector re-rating. As capital expenditure stabilizes and free cash flow inflects toward $80 billion in the coming years, the quarterly dividend, recently hiked to 6 NT dollars, has significant room to grow, which would attract a new base of institutional income investors. Furthermore, TSMC currently trades at a 30% discount to peers like NVIDIA. If the market closes this gap as AI demand proves durable through 2027, a move to a 30 times forward multiple alone would value the stock at $419.
Bottom line.
To conclude our assessment, the investment case for TSMC remains intact as long as 3 primary conditions are met over the next 2 to 3 years. First, the artificial intelligence capital expenditure cycle must remain robust. Second, the The company must continue to deliver financial results within approximately 2 percentage points of its provided guidance. Finally, there must be no significant geopolitical shock in Taiwan. While none of these outcomes are guaranteed, current market evidence and management execution support this path. Conversely, the investment thesis would break if we see a sharp deceleration in AI spending, particularly if hyperscaler capital expenditure guides show weakness during the April earnings cycle. The thesis is also vulnerable if trade tariffs escalate beyond the current framework, or if sustained capital expenditures permanently prevent the projected recovery in free cash flow. It is important to note that geopolitical tail risk is a factor that cannot be fully modeled away and must be managed through appropriate position sizing within a portfolio.
Thank you for your attention.
Disclaimer: this report is prepared for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any security. I have no business relationship with any company mentioned in this post, nor do I hold any shares, options, or derivatives in them. I have no plans to initiate any positions within the next 72 hours. This article reflects my own independent research and opinions. I am not receiving compensation for it. Markets are unpredictable, and past performance does not guarantee future results. Please do your own research or consult a licensed financial advisor before making any investment decisions. Investing can be risky and may not be suitable for all investors. All data sourced from company filings, earnings calls, announcements, and publicly available analyst research as of March 10, 2026.